All right, let's dive right into this explainer. Welcome to the briefing. Today, we're running a high-level audit on your personal capital allocation. We're looking for those operational inefficiencies that are silently draining your wealth. Think about it. You manage complex projects, lead teams, and generate massive top-line revenue for your company, right? But if your personal balance sheet isn't growing at the end of the quarter, well, your internal systems are failing.
To respect your time, here is exactly what we're going to audit today. First, the high-income paradox. Then, fixing cash flow leaks, followed by risk management blind spots and missed growth opportunities. Finally, we'll wrap up with your 2026 strategic plan.
Okay, moving into section 1, the high-income paradox. Let's address a fatal misconception that routinely trips up highly successful operators. 60%. That is the staggering percentage of Americans living paycheck to paycheck in 2026. And here's the massive red flag for this room. That statistic heavily indexes professionals earning well into the six figures. Crazy, right? And this illustrates the core operational issue perfectly. A high income simply does not equal true wealth. Your salary? That's just top-line cash flow. True wealth is your retained earnings. It requires robust systems to prevent capital bleed. Wealth is what stays on your balance sheet, not just what passes through your P&L. So let's transition to section 2 and look at your operational cash flow. We need to identify exactly where your monthly P&L is silently leaking capital. The most common operational failure, treating savings as a residual. Saving whatever's left over. Most professionals run their personal finances like a failing startup. They pay their vendors, cover their OpEx, and just kind of hope for a profit margin at the end of the month. But human nature pretty much guarantees that leftover margin is zero. So we absolutely have to flip the script here and automate your profit margin. Step 1, pay your balance sheet first. Step 2, set up an auto transfer to move 10 to 20% into savings the exact second your direct deposit hits. Then, step 3, fund your daily OpEx with whatever remains. To put it in perspective, automating just $200 a month builds a $12,000 runway in 5 years, plus interest, totally out of sight. You also really need to watch out for lifestyle inflation. It's the silent margin killer of the upper middle class. It happens when every bonus or equity payout gets immediately absorbed by upgraded liabilities. You make VP, you lease the Porsche. Hit your KPI bonus, upgrade the penthouse. Your top line goes up, but your bottom line stays exactly the same. The strategic patch for this is simple. Capture the ROI of your career growth by routing 50% of any new raise or bonus directly to your investment portfolio before it even hits your checking account. Go ahead and enjoy the other half. You'll literally never miss capital you'll never see, but your net worth is going to scale exponentially. All right, moving to section 3, risk management blind spots. Let's assess how you're protecting your existing assets and your financial credibility. Your credit score is a vital KPI that impacts your cost of capital. What's really interesting here is that a massive 35% of your score relies purely on making on-time payments. In 2026, this metric dictates everything from mortgage rates to insurance premiums. A careless 100-point drop because of a simple administrative oversight, that will cost you tens of thousands in lifetime interest, no question. So the immediate risk management tactics are super straightforward. Check your score for free today at Credit Karma or annualcreditreport.com. Pay every single bill on time to secure that 35% block. Keep your overall credit card utilization below 30% of your limit and avoid opening a bunch of new accounts all at once. Improving your score from a 620 to a 750 using these steps can easily save you $200 to $400 a month on a mortgage alone. We also have to audit your liquidity. Look at this, an average $3,500 life event, like an unexpected ER visit or a major car repair. Without liquidity reserves, that unexpected OpEx goes straight onto a credit card, bleeding you at 24% APY. It forces you right into a toxic debt spiral. But fixing this liquidity gap actually requires minimal capital deployment. This table perfectly lays out the math. Automating just $50 to $100 a week into a high-yield savings account, which is yielding around 4.5% to 5% right now, builds an impenetrable risk buffer. $100 a week scales to over $5,000 in just 12 months. That single account turns a potential fiscal disaster into a minor administrative annoyance. Next up is section 4, missed growth opportunities. We have to address growth stagnation because keeping all your capital in basic savings isn't playing it safe. It's a massive strategic error. Just compare basic savings, which gets actively eroded by a 3% inflation rate,
against the historical 10% annualized return of the broader stock market. If your capital is parked in a standard checking account, you aren't even breaking even. You're actually accepting a guaranteed negative return on your purchasing power, and that's just bad business. As the saying goes, time in the market beats timing the market every single time. The biggest strategic error high earners make is analysis paralysis. Every year you delay deployment is compound interest actively working against your bottom line instead of for it. The absolute most important operational step you can take for growth is simply executing this week. Open a Roth IRA at an established brokerage like Fidelity or Vanguard. Invest in broad market index funds like VTI or VOO, and just start with whatever capital you can allocate right now, even if it's just $50 a month. Building the automated system is far more crucial than the initial deposit amount. Finally, let's consolidate all these fixes into Section 5, your 2026 strategic plan. This is your concrete implementation roadmap. Here's your exact sequence of quarter-by-quarter deliverables to completely overhaul your financial systems. This week, check your credit score and set up that automated payday transfer to a high-yield savings account. This month, open that Roth IRA and deploy your first investment, regardless of the amount. And this year, eliminate any high-interest debt and build out a full 3 to 6 month emergency liquidity fund. And that brings us to the ultimate question for this briefing. Will you execute the plan or keep getting the same results? You now know exactly what's draining your capital. The only question left is whether you'll manage your personal wealth with the exact same ruthless efficiency you bring to your career, or if you'll let these silent leaks continue. Execute this roadmap, and 2026 will be the year your financial baseline skills permanently.